A bond market collapse is coming. I'm your host, Michael Cowan, and thanks for joining me today. In today's video, we're going to go over how the bond market is signaling the unthinkable. We're going to go over how we're in a once-in-a-generation bond market collapse, why this is going to affect stocks, why this is going to affect real estate, and why we all have to start paying attention to this $115 trillion bond market right now. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Well, okay, people, look at this. Global bonds tumble into their first bear market in a generation. And that's exactly right, people. What have we seen in the bond market over the past 40 years? We've just seen a 40-year rally since central banks have started quantitative easing, since they've started buying these US treasuries, these bonds, and in COVID, they even started buying junk bonds. So a lot of investors thought this was just a surefire way to make money, a risk-free way to make money. Unfortunately, what this means is a lot of baby boomers are heading into retirement. And normally what happens with people's 401ks, or in Australia, their superannuation, normally their portfolios start to get heavily weighted into bonds. And right now we are seeing bonds crash just as much, if not more, than the stock market. The Bloomberg index has dropped 20% from its January 2021 peak, and hawkish central banks send bonds tumbling along with stocks. And that's right, people. We can see here the iShares 20-year plus Treasury bond ETF. This is TLT. We can see here it is down from its peak in August 2020. It is down 35%. And if you thought the worst may be over, well, you'll be mistaken. There's going to be much more pain coming ahead, and this could be just the beginning. Look at this. No escape from the biggest bond loss in decades as the Fed keeps hiking. And the odds are there's going to be a 75 basis point hike this month, and BlackRock Rick's Reader sees more upside for 10-year Treasury yields. So that's exactly right, people. It is looking more likely than not, the odds are greater than 50% that the Federal Reserve at their meeting this month is going to hike interest rates yet again by 75 basis points. That will take the federal funds rate to 3%. It's been a long time since we've seen the federal funds rate above 3%, and many people thought there would be no way they'd get to this level. They thought it would be impossible, but unfortunately, the Federal Reserve is going to have to go even higher than this. And many Fed officials are starting to say that they're going to need to lift interest rates above 4%, and there's going to be no cuts at least through 2023. Because what were the central bankers saying? They were saying, look, don't worry, there'll only be a few rate hikes this year, and then we'll start cutting in 2023. Well, now we're seeing there's even greater rate hikes. Remember, they were saying there's no chance of a 50 basis point hikes, and then they did the 50 basis point hike. They were saying there's no chance of a 75 basis point hike, which is 0.75%, and then they did it. And then they're saying, well, don't worry, we'll cut interest rates in 2023. And now they're saying, well, there's going to be no cuts in 2023. So this is why you can't listen to what central bankers are saying. You have to look at the data, because the central bankers are forced to react to the data. And the data is telling us that inflation is still stubbornly high. They're going to have to hike interest rates higher. And what a lot of people aren't talking about, what they're doing now is quantitative tightening. They're reducing assets on the balance sheet. What they have been doing is they've acquired $9 trillion worth of assets of US treasuries and mortgage-backed securities. They're going to be letting some of those securities mature. And yes, while some people have been saying, look, they've been adding to their balance sheet, they've still been buying mortgage-backed securities. That's because they've had to let some of these assets settle, which have taken over 3 months for the mortgage-backed securities. But now they are going to be selling them. And while some people are saying, no, they're not going to sell any at all, they're just going to let them mature. Yes, they will let some assets mature, but they're also going to be selling them if they don't reach that $90 billion amount of US treasuries maturing. And another major indicator that happened at the start of 2020 was when the 10 and the 2-year yield inverted. And this is predicted every single recession. And what I'm seeing now in the bond market is something absolutely alarming. Look at this. We can see here, this is the spread between the 10 and 2-year treasury yield. We can see here it inverted on April 1st, 2022. It inverted again on July 6th and has remained inverted and went all the way down to a difference of nearly 0.5% and has remained inverted all the way now for at least 2 months. And we don't know how much steeper this inversion is going to get. So you may be thinking, okay, well, things are looking bad for the bond market, but that shouldn't affect my stocks, cryptocurrency, or real estate portfolio, should it? Yes, it will, people. It will affect it massively. And this is why. For example, as people sell bonds and as bonds lose value, the yields or the interest rate on these bonds go up, and this makes it more expensive to borrow. This creates less debt, so it's going to be more expensive for your mortgage. It's going to be more expensive for companies to raise capital, especially we've seen all these companies that haven't had any profitability. They haven't even had any revenue. We've seen all them crash. We've seen the NASDAQ fall over 30% from its recent peak, and we've seen cryptocurrencies collapse and many cryptocurrency hedge funds, many cryptocurrency companies go bust because of this high cost of debt. And again, the bond market, the global bond market is valued at $120 trillion. And just alone, the US is valued at 46 trillion. So for every 10% this market falls in value, that's nearly $12 trillion of wealth wiped out like that. That's $12 trillion less than we can put in the stock market. That's $12 trillion less than we can put in cryptocurrency, real estate. So this affects the whole global economy. And this is why stock market, not just the US, Europe, UK, Australia, etc., gets so scared when central banks start doing quantitative tightening, when they start selling these assets, because they know this evaporates global wealth. Again, for all the people that are going to be retiring, this is going to diminish their retirement portfolio, so they're going to have less money to spend in retirement. This is going to affect companies' earnings and again affect their stock market valuations. So everyone, not financial advice, but me personally, I wouldn't be touching bonds at the moment, especially when central banks are going to get much more aggressive. I think interest rates are going to go much higher. This is going to lead to a much steeper stock market crash than we're seeing now, and we're going to see a real estate crash as well. So what I'm doing, I'm just waiting patiently on the side, building cash, because the US dollar sure has been increasing in value. If you look at the DXY index, this has been skyrocketing lately, and I'll be waiting patiently on the sidelines for when there's going to be much better deals coming ahead. Much cheaper stocks, cryptocurrencies, real estate, many luxury items, cars, boats, RVs, etc. Many people are going to be forced to sell these during the great recession that is coming ahead, which could lead to a depression. So everyone, this was just a quick update and warning what's happening in the bond market, something I think you should all be watching. What do you think about this? Let me know. Let me know if you know which YouTuber I was impersonating in the intro and the outro below. Thanks for watching. Thanks for being fans. Bye now. Everyone realize on the channel is to be provided for education and for ways without any express on the applied warranty, including the warranties of accuracy and complements and fitness.